Good afternoon. Welcome everyone to our Macro Insight live stream. Today's date is 11 March 2024, 4 p.m. and here we are at DBS Asia Central Studio. My name is Wei Liang Chang, FX and Credit Strategist with DBS Group Research. With me today is Moji, who is our Chief Economist for China and Hong Kong, and also Han Teng Chua, who is our Singapore economist. So the topics we'll discuss today are three very interesting topics and relevant for given market developments. The first aspect that we're looking at is what's happening in risk markets. We're seeing very strong rebounds in risk assets across equities, credit, and even crypto. So what are the drivers behind it? We'll try to go through that in some detail. Following that, Mo will be talking about China and Hong Kong, recent developments around the MPC meeting, as well as what's her outlook on Hong Kong. And finally, Han Teng will round off with his comments on Singapore's budget development. So moving to our section, before we do that, we would like to direct viewers to Pigeonhole. This is basically a two-way conversation. It's not just us expressing our views, but we also would like to hear questions from our viewers in terms of what's the top of the mind, and what some key topics they would like to hear more of from either me or the other presenters in today's live stream. So you can either scan the QR code on screen, or you can go to dbs.pigeonhole.at and enter the passcode MACROMarch24. Feel free to insert your questions throughout the session, and we'll take it at the end of a Han Teng session towards the end of the presentation. And so with that, we'll kick off our presentation. I'll talk about what's happening in risk asset markets. And really it's important to give a description of the scenario that's driving market sentiment, as well as the very strong, perhaps even exuberant conditions in equity and credit markets. So first up, we're seeing actually markets turning more optimistic on the growth front. And that's for good reasons, despite many difficulties faced by the global economy, including conflict in the Middle East, potential supply chain disruptions arising from attacks in the Red Sea, geopolitical conflicts, uncertainty with regards to the US banking sector and commercial real estate loans exposure. By and large, we're seeing growth continue to hold up quite well, especially in the US. So if you look at the latest growth forecasts from international organizations, including the IMF and OECD, they have been revising up growth forecasts for the world in the last 3 months or so. For the IMF, they're now looking at global growth to increase to 3.1% in 2024 versus 2.9% back in October. And a very same scenario can be said for OECD, where they have revised up forecasts from 2.7% to 2.9%. Part of it is due to the fact that consumption momentum in the US continue to be strong. We have seen the US consumer balance sheets in pretty good shape, despite the fact that interest rates have been on a rising trajectory for a long time. And that's really supported by, I would say, very strong labor market outcomes in the US, on top of the fact that wage growth has been relatively resilient, despite all the headwinds that I've mentioned earlier. At the same time, it's also important to look at what's happening in the rest of the world. So here, I think China is turning out to be slightly better than what some market commentators were expecting. We are looking at a revision of growth forecasts from the IMF from 4.2% in October last year to 4.6%. So there's a bit more confidence around China in markets, of course, from a very low base where sentiment is still fragile, particularly in the equity markets. And that's a segment that more will focus on. But not just the growth picture is improving. If you look at the inflation picture, I think that's where there's even more expectations that the global economy could be entering a soft landing scenario, where inflation rates across the world are coming off from very high levels back towards the central bank targets. And that in turn will create space for central banks to gradually dial back the policy restrictiveness and also begin to ease rates in order to support growth and keep real rates at a relatively consistent level. So the chart on the right shows inflation outcomes for 2023 on the x-axis and inflation forecasts on the y-axis. And generally, you will notice that most points on this line are lying below the 45 degrees line. So what that means is that most of the world's economies are expected to see a deceleration in their inflation rates. So for instance, in the US, inflation could fall from around 4% in 2023 down to our forecast of 3% for 2024. And generally, very few economies will see inflation accelerating. Even if they move up, they tend to be moving up from a relatively low base. I would say China is probably the main exception to this, where inflation is moving up from what I would say to be relatively low levels compared to previous history. So by and large, inflation for the global economy is on a trend that seems to reinforce the narrative of soft landing. And that, to some extent, is supporting market sentiment, is causing market participants to price in a relatively more dovish outlook, for instance, from the Fed. So just last week, Jerome Powell, in his congressional testimony, he has mentioned that the Fed thinks that rates are perhaps past their peak, and they are really looking for evidence and confidence that inflation is on a sustainable path towards the 2% target. And once that confidence is in place, that means the Fed is likely to be cutting rates. Our expectation is for the Fed to be cutting rates starting sometime in the middle of the year, and we're looking for about 50 basis rate cuts in Q3 and an additional 50 basis rate cuts in Q4. So given this scenario, it seems to be a more benign, more positive policy environment for global markets, with the Fed moving away from tightening policy and trying to restrain market sentiment towards perhaps providing more support in the form of more accommodative policy rates. So what is the most recent developments and what is the outcome of this soft landing perspective and narrative? So what we're seeing is US markets buoyancy broadening, not just in equities, where a lot of interest have been obviously on the tech sector, given excitement over AI, excitement over tech earnings, but we're seeing a bit of a broadening across to improving sentiment across more sectors. So for instance, we're seeing the S&P 500 index breaching 5,000 and is now heading and setting record highs. And not only that, we are also starting to see that kind of sentiment, exuberance, if you may, also being exhibited in the credit market. So for instance, if we look at the US investment-grade credit markets, they have staged a bit of a recovery from late October levels as global sentiment improves. Of course, the recovery is not as strong as what we've seen in equities for a few reasons, not least of which is rates are still quite high. But if you look at it from the credit spread perspective, things are actually as exuberant as they come. So for instance, if you look at the chart on the right, it shows the investment grade and high yield credit default swap spreads. So these are indicators of demand for credit assets and also to some extent markets pricing of credit risks in the US corporate credit market. And we've seen spreads compressing pretty sharply from the October highs, and they are now trading quite close to where they were at the start of 2022, which is way before the Fed begins to hike rates. So that's really an indicator of how powerful markets' expectations are. They're looking forward to a period of more supportive Fed policy for markets, and to some extent, that's being reflected in not just equities, but credit assets. But as I've mentioned, credit as a whole is still not back to its previous 2022 highs, and that's largely really reflecting what's happening in rates. Rates have seen a little bit of a sell-off at the start of the year as markets were keen to push back pricing of Fed rate cuts expectations. So initially, I think markets were looking at rate cuts perhaps in March and April this year, and now, given this push out of rate expectations, given relatively resilient, strong data, we've seen a bit of a sell-off in US rates. 10-year yield has crawled a little bit higher. If you look at the Bloomberg Global Aggregate Index, which is a basket of advanced economies, corporate bonds, yields have also crawled a bit higher. But I would say that's not necessarily to the detriment of risk sentiment, because that climb in rates has been relatively shallow. We have not seen very sharp increases that would jeopardize investor sentiment, that could perhaps make investors question whether it's worth investing in credit as compared to risky assets, risk-free assets such as US Treasuries. And if you look at not just credit spreads or bond prices, even issuance activity is showing, I think, quite clear signs of buoyancy. So if you look at the year-to-date corporate bond issuance in the US, we have seen issuance outpacing the year-to-date gains seen back in 2020-21, which is during the pandemic year. So it's very clear. Market conditions are as bullish as they can get, and it's comparable to the level of exuberance that we've seen during the pandemic days of 2021. So 2022 and 2023, we have seen issuance activity fall quite significantly. But now it appears to be the case that 2024 could be an indicator of a reversal of that trend. We could see issuance even outpacing the heydays of 2021 and 2020, where corporate will find it generally easy to tap credit markets for funding. That could perhaps indicate that refinancing risk will not be as large an issue as what some would have thought at the end of last year. And it's not only traditional assets such as equities and credit that are doing well. If you look at even alternative assets such as gold and Bitcoin, they are actually all trading back to record highs. For Bitcoin, of course, there are several idiosyncratic events. We have seen the approval of Bitcoin ETFs by the SEC in the US. That probably catalyzed a little bit of an uplift in sentiment towards Bitcoin. And also at the same time, there's this halving event in Bitcoin. The mining reward for Bitcoin miners will fall by half, and that's probably going to spark some degree of a rise in value of Bitcoin. But by and large, we are seeing that we think that these two assets are reflecting very buoyant risk sentiment. Back in 2020, we were researching on Bitcoin, and we were one of the first to report that Bitcoin is behaving more like traditional risky assets. That report was carried in Bloomberg. And indeed, if you look at the correlations of Bitcoin with the S&P 500 and with the VIX, it's positively correlated with US equities, negative correlated with implied volatility of equities. And that shows that it has very clear assets, characteristic of a risky asset. So to some extent, Bitcoin is benefiting from this benign market conditions. That's why it's heading back to its pandemic highs and even breaking its records. It was trading above 70K for a short time, and it's now eased back somewhat, but the trend appears to be still quite strong for this asset class. Gold is a bit of a special case because gold is not traditionally considered as a risky asset. It's considered more of a safe haven. So why is it doing as well as Bitcoin? And I think this is the part where we need to bring in some common underlying drivers, which is really how the US dollar is behaving. We know that if the US dollar weakens, that's generally positive for risky assets. And the US dollar is going to be very sensitive to how the Fed responds in its policy stance towards the later half of this year. So this is a chart of the DXY index across the last 2 years. So in 2022, we have seen very sharp rise in the DXY index. That largely reflects the fact that the Fed was on a policy tightening stance. They were aggressively hiking rates by 50 basis, 75 basis per meeting. That drives up demand for the dollar, partly because of carry, but also partly because of the fact that people looking for safe havens. We have seen asset markets sell off during that period of time. In 2023, as Fed moves to a more steady pace of rate increases and eventually decides to hold policy rates unchanged, we saw the dollar consolidating in a very tight range from around 100 to 105 on the DXY index. And now in 2024, as markets are looking forward to prospects of rate cuts, I think pretty much that would indicate that the DXY could be close to a peak and will be heading a bit lower in anticipation of that. And that's broadly supportive for risky assets, as well as commodities, including gold, which are priced in the US dollar. So finally, before I conclude, I will touch a little bit on Chinese markets and Asian markets in general. So we've seen Asian credit spreads actually narrowing quite substantially since on a year-to-date basis, and that's more or less in line with our call for Asian credit market relative outperformance compared to US markets. We've seen China and Hong Kong credit leading the way in Asia, seeing spread compressing by between 25 to 35 basis on a year-to-date basis. And that's partly due to the fact that China has been rather proactive in terms of providing support to markets. We've seen RRR cuts, we've seen adjustment in the 5-year LPR. And also at the same time, they have taken a more stern approach towards institutional equity selling onshore to try to contain equity market sentiment, to try to support market sentiment. And that's very clearly seen if you look at the Chinese stock index, CSI 300 index. We've seen a bit of a bottoming coming through in January, a bit of a rise in inflows, northbound inflows through the Stock Connect mechanism. That really indicates, to some extent, investors' hopes that policy support measures will come through that will really support rebound in earnings and Chinese growth and so forth. So just last week, we had 2 sessions in China where the NPC set a growth target of 5%. And I think to some extent, how markets are going to behave for China will depend on how confident they are in terms of whether this growth target can be realized. And so with that, I think it's a good time for me to pass the baton to our Chief China Economist, Mo, to explain a little bit more about her outlook for China.
Thank you, Wei Liang. Just minutes ago, China's NPC just ended, so they just approved the government work report. And from the government work report that was released on Monday, I think last Monday, I think that's very clear. Next page, please. Next page. I think that was very clear. It's a combination of very bold GDP target, but restrained fiscal target, and also prudent monetary policy support. But China's economy is facing persistent downward pressure that requires persistent easing. So we think overall, China has to ease much more in 2024 to achieve the targets, and it has to surprise to the upside in order to stabilize the economy, but also to achieve their goal of high quality growth. Let's go into the specific targets they have been ending up. They have been ending up by saying 2024, they want to achieve 5% GDP growth rate, whereas last year, 5.2%. So we think it's bold because last year is a reopening trade. The contribution from reopening to the 5.2% is around 2%. But 2024, we don't have that. But in terms of fiscal policy, we know last year, China's fiscal deficit is 4.6% of GDP. But this year, they set up the target at 3%. It's a bit of restraint. So we think it will have to surprise to the upside in 2024 to really try to stabilize the current economic downturn. If you look at the right-hand side chart, you see China's fixed asset investment. The biggest drag continues to be from the property sector. Property overhang will be the biggest threat to the economy. Next page, please. China also set the target of employment for 2024. They think they want to create 12 million new jobs in 2024. But we also know China in 2024 July time will be around 12 million of the undergraduates. That means they will have to be mismatched for this whole job market. They actually need around 30 million to 40 million manufacturing workers, but no college graduates wants to go. They also need around 10 million of the medical workers, but they are still lack of. So the government has to spend a lot of money to really try to train these cohorts. to really make sure the job markets work well. So that's why the government revised up their unemployment forecast from 5.1% in 2023 to 5.5% in 2024. Chinese government also set up the target for CPI at 3%, but last year they only achieved 0.2%. So that is why there is a concern in the market. Can China really achieve this? Market should know the 3% is just a ceiling they do not want to surpass. It doesn't mean they have to achieve the 3%. So we think CPI will continue to recover. Like over the weekend, the data has been showing 0.7% increase given the cold winter and also, the mismatch in terms of Chinese New Year. But it wouldn't be as strong as a 3% reading. So China's still facing this inflation pressure given the core CPI continues to have the burden, from the demand side. It's very weak. Lastly, we also want to highlight for China in 2024, in order to achieve this 5%, as the NDRC chairman has been saying, they need a jump, and we certainly believe they have to do much more easing to try to help stabilize the economy and ensure the high quality of the growth. Next page, please. Hong Kong also recently released its Hong Kong budget. We know within the Hong Kong budget, they made it very clear Hong Kong wants to achieve 2.5 to 3.5% GDP growth rate. And last year, they have a fiscal deficit of minus 3.4% of GDP. And we think in 2024, given all the measures and revenue income, they at least have to have around 2.5% of the fiscal deficit to ensure, they can support the current GDP forecast. And also, if we go to next page, please. We see for Hong Kong, given there are a lot of concerns about its future, so that's why we have been writing the paper. We don't think the game is over, even though currently we see the regional headquarters of foreign companies are leaving Hong Kong, but we're also seeing a reverse trend of the Chinese companies are setting up headquarters in Hong Kong as well. But one thing within facing Hong Kong market, one important thing is also the same as the Chinese market is about the property market. Hong Kong government has been very bold in terms of scraping out all the stamp duty taxes. So everything the budget announced from the second day and until now we have been tracking. The daily transaction cases before the budget is 11 cases. And now is 118 cases per day. That meaning it's 10 times more of the transactions. So this will help release the pressure from the housing market, certainly. Overall, we think Hong Kong, the game is not over and it's hardly over. It's based on many different things. Most importantly, Hong Kong is very advanced in terms of the rule of law. Hong Kong is a potential and also already the private wealth and asset management center. Hong Kong, in terms of the talent acquisition, there is a strong inflow of the talent into Hong Kong and also the strong, inflow of the companies into Hong Kong as well. We need to really emphasize and also pay attention to all these, new trends that is emerging after what has happened, we as 5 years ago. So in conclusion, we think both China and Hong Kong economy are facing potential challenges, but there are tremendous of measures has been taken place both from China and Hong Kong to try to support their economy. So 2024 would be something we need to really closely look at. There may be some bottoming signs before they both recover. Thank you. Back to you.
Thank you, Mo.
the Singapore budget. If you have any questions that you would like us to answer after the presentation, please scan this QR code and head over to Pigeonhole and put on your various questions that you would like to ask. So now let me move on to the Singapore budget. So over the past couple of days, we have seen the budget being debated in Parliament, and it has been actually unanimously being approved in Parliament. And overall, we think budget 2024 is one that is prudent with targeted support. Just looking first at the overall fiscal position, we think Singapore has run a quite prudent fiscal position over many years. And during the pandemic, you may have seen, a huge deficit that's being ran. This pandemic support was actually being drawn from past reserves and not from debt issuance, like in many other advanced or emerging economies. In fact, in FY 2021 and FY 2022, the government has actually budgeted for deficits, but in fact has outperformed with surpluses over the past in FY 2021 and 2022 due to the very strong recovery from the COVID-19 pandemic. And therefore, this better than expected overall fiscal performance provided some near-term fiscal flexibility in FY 2023 and the current budget 2024. And we can see here the various key support areas provided in budget 2024. And this can be bucketed into 4 broad components. So firstly, the budget aims to provide better growth and jobs over the long term, and also tackle some of the near-term challenges such as the high business costs that Singapore businesses are facing. Secondly, the budget also seeks to refresh the social compact and also provide assurances and inclusivity, whether it's with regards to the near-term challenges such as the high cost of living, or in the long term in terms of assurances, whether it's in retirement or in terms of job disruption. Certainly, we are moving into a more uncertain world, and Singapore, as a small and open economy, will have to live in this uncertain world. The Singapore government in its budget said that it's aiming for 2 to 3% annual growth over the next decade. I have to put this into context. So Singapore's economy managed to achieve around 3% growth in the past decade. And this is considering the ups and downs, whether before the pandemic due to the US-China trade tensions, or the pandemic itself, which has created a lot of volatility globally and also for Singapore. In 2024, we are expecting growth to pick up to 2.2%, so still slightly below the average 3% growth that has been achieved in the past decade. But anyway, the government has put forth some supportive measures in budget 2024 to try to drive the next lap of Singapore's growth, aiming at 2 to 3% annually over the next decade. Businesses, one of their key challenge is the high business costs, and ultimately one of which is wage increments. With Singapore's population also aging, productivity gains will be key, and this will be also key to sustaining the wage increments. If we do a comparison with Singapore with other advanced G7 economies and also those in Asia Pacific, we see that Singapore has actually been quite wage competitive with quite high productivity. And that one reason for that is Singapore is competitively globally, as seen from this IMD World Competitiveness Survey. So Singapore will continue to try to remain attractive over the coming years. One way to do so is to continue to anchor high-quality investments in Singapore, and investment promotion and attracting MNCs to come to Singapore remains a cornerstone in promoting Singapore's growth. So although foreign enterprises account for 20% of the total count of enterprises in Singapore, in terms of nominal value add, they actually account for 70%. And if you can think about it, local enterprises are actually key suppliers to these NMCs. So continue to attract these NMCs to Singapore is quite important. And we've seen from the fixed asset investment commitments numbers, Singapore has managed to achieve sustained foreign investment inflows into Singapore and continues to target around 8 to 10 billion as part of its medium-term targets. Amid a shifting corporate tax landscape due to the implementation of BEPS 2.0, Pillar 2, which will be implemented in Singapore starting from 2025, Singapore has also tried to keep its competitiveness by introducing a new refundable investment credit, which you might have read in the news. And that would help to keep Singapore attractive amid this competition for investments. And also, the top-up to certain funds, such as the National Productivity Fund, will also help Singapore to anchor high-quality investments here. The second way Singapore can achieve growth is to continue to drive innovation and ride emerging trends. One of which is the government is topping up and investing more in R&D. Here we can see, against a comparison of advanced economies, Singapore's R&D spending as a share of GDP is sort of middle of the pack and quite decent. You have at the end of the spectrum, South Korea, which is a leading semiconductor economy, and they are spending around 5%. So Singapore being middle of the pack is still really decent, and they are making more investments in this front. Secondly, in terms of riding emerging trends, one of which is sustainability and the decarbonization. So Singapore is trying to shift its energy mix towards renewables and aiming to have renewable energy imports account for around 30% of the total energy mix by 2035. And in this regard, in the budget, we have seen certain enhancements, whether it's in terms of energy efficiency grant or in terms of the enterprise financing scheme green, which would help to support some of this adoption of green solutions. That will help to allow Singapore companies to ride some of these emerging trends. And not to forget, Singapore is putting up around 5 billion in its new future energy fund to sort of categorize some of this public-private partnership. After all, Singapore's most important resource is human capital. And here I have a human capital index from the World Bank. And again, I compare it with a number of advanced economies. And Singapore ranks highly here and will continue to put in quite heavy human capital investments. And this is quite critical. But with Singapore's population aging, the share of the labor force that is above 40, meaning those that are workers which are matured, is also rising. And from the right chart here, we can see that for mature workers, those aged 40 and above, the re-entry rates after retrenchment post 6 months is actually much lower than that of younger workers. And we know that retrenchments have actually risen in 2023, and NTUC has signaled that there could be increase in retrenchments in 2024. So the government in the budget 2024 has announced a new Skills Future Level Up program, and this really targets the mature workers in terms of reskilling. So this would allow these mature workers to update their skill sets and remain relevant, and would be less disrupted by technologies such as AI. And other than those that are 40 and above now, the government has actually also committed to giving top up to SkillsFuture for those that are turning 40 in the future. So basically, making a strong commitment in terms of lifelong learning for Singaporeans and its residents. So Singapore's budget 2024 is also a forward Singapore budget. We've seen that last year in October 2023, the Forward Singapore exercise was being concluded with 7 key shifts that's being identified. And this covers the broad range of population, whether you are young and seeking education, or whether you are old and are looking towards retirement. Why do I say the Singapore budget is a forward Singapore budget? This actually marks the first installment of the Forward Singapore policy, in that FY 2024 saw spending of around $5 billion, and this would rise, until around 40 billion in total by the end of this decade. So this year really marks the start of executing this Forward Singapore initiatives that is being led by the 4G leadership. And we know that leadership transition is upcoming in 2024. So spending is expected to rise over the coming years. And here, I show 2 charts where Singapore will see rising fiscal spending pressures. So in terms of operating and development expenditure, including that of special transfers, that has been rising over the past decade, even before the pandemic, and is projected to reach around 20% of GDP by FY 2030. Just drilling into the operating and development expenditures, we see that 3 out of the 5 expenditures are actually social categories. So for example, health in terms of tackling the aging population, education in terms of equipping our workforce and the younger Singaporeans in terms of learning, and as well as in terms of transport and national development, ensuring there's sufficient infrastructure to support Singapore's growth. And lastly, I would like to point out that actually, other than social categories, defense is actually the top spending category for the Singapore government. And this is important given that the external environment is increasingly volatile. Over the past couple of years, we have seen that other than rising operating and development expenditures, special transfers have also increased. So we have seen this increase in FY 2023 and FY 2024 to the highest level since that of the pandemic in FY 2020. If you can look at the right table, actually it's not just about support to businesses and households in the near term. It's about the long-term development initiatives. And if you add up the numbers here to the Future Energy Fund, National Productivity Fund, Financial Sector Development Fund, and National Research Fund, this actually accounts almost half of the special transfers in FY 2024. So there is certainly quite some investments that are being made in terms of long-term development initiatives and to drive Singapore's growth over the next decade. So given the rising fiscal spending pressures, we see that the authorities are still adhering to fiscal prudence and trying to sustain revenues and maintain a balanced budget. A couple of key moves have been made in previous budgets to adhere to fiscal prudence and ensure that Singapore's budget remains sustainable. One of which is the GST hikes, 2 percentage points hikes to 9%, starting from January this year. That is 9%. And you see that this has helped to lift revenues in recent years and will continue to support the rising spending pressures that are expected over the coming years. The other important component is the net investment return contribution, and this has also supported rising fiscal outlays. We see that it's roughly around more than 3% of GDP, and this would remain quite crucial in sustaining Singapore's budget over coming years and the spending pressures as well. And reserves is being seen as an important part of Singapore's social compact. So in summary, we've seen that the budget is quite comprehensive, providing support in various areas, and in particularly providing support for the long haul. And even amid rising spending pressures, we see this adherence to fiscal prudence, which is quite important in Singapore's key strength. In fact, this is a key point why Singapore is able to maintain its AAA sovereign credit rating, which is quite rare nowadays. Thank you.
Right. Thank you, Han Teng. So do remember, if you want to post questions, please go to Pigeonhole. You don't even have to post questions. You can vote for questions that you want to be answered, and we'll also address those as well. And so this is the site to go to, dbs.pigeonhole.at, passcode macro March 24. Right, so I'll kick off the Q&A session with, I think, the first two questions. The most outvoted questions are all about China. So Mo, directed at you. How will you assess China's fiscal stimulus? Will there be any upside to, I guess, the fiscal deficit target, 3% of GDP? Do you think corporate profits in China will also surprise on the upside? And I think a very similar question is, what are the positives you're seeing in China's current economic and market recovery? So we've seen a bit of tentative recovery in Chinese equity markets. So I think the question is really about, can it be sustained? What are the policy measures that can be supportive of growth? So Mo, over to you.
Thank you, Wei Liang. Here, in terms of fiscal stimulus, we think China certainly has to do. So usually you only see the 3% is a fiscal deficit, a percent of GDP. But you also have to add up, there's a 3.9 trillion special local government bond. And also you have to add another one ultra long, government bond. If you add up all this together, it's already equal to 6.6% of GDP. So this is why it's not 3%, it's already 6.6, right? What they have promised. But we think on top of it, the government has to even spend much more. Usually, under economic, difficulties time, China's, the total deficit of GDP, we will see in the broad term is over 10%. So we think there certainly is upside. The second question is about the corporate profits. If you look at the data, the latest data is by end of December, it's already, in terms of the contract, it's still contracting, but it's already improving. So we see it's already bottoming out. So at minus 2.9%, but before it's double-digit decline. Now it's only almost close to 0%. So we think highly likely into the second half of the year, corporate profits will start to finally improve. And the positives, because we have been talking a lot about the challenges, but we also need to observe any of the positives coming to both from the policy side, from the corporate side, but also from the market side. I want to highlight 6. Number 1 is about China's exports and imports. If you see the data from last week, exports surprised with upside by over 7% growth, and also imports by over 3% growth. What does this mean? This means both internal demand, domestic demand, and also external demand are all very positive. So this is something is cheerful. Number two, in terms of China's PMI, usually we look at the NBS, the official PMI, but also we need to look at the Caixin PMI. That's about the SMEs. So they are all now in expansionary, territory at 50.9, 0.1% of improve from last month. So this also something is very positive. We see SME is improving. Number three is also about the Chinese New Year holiday. The traffic, is at 470 million people going out. This is a historical high. That's also 19% higher than the 2019 level. In terms of revenue, it's 8% higher than the 2019 level. You may ask me, say, in terms of the per capita, per tourist, it's still 91%, but in terms of aggregate, the contribution to GDP, that's already historical high. Number four, I think I want to mentioning is about China's money supply. So M1 grocery is very important. It's coming back to 5.9% in January, and also the data is going to be released later this week. So we closely monitor. It's already at 5.9%. So what does it mean? That means corporates is going to spend. Whenever they're going to spend, meaning they either want to do the capital expansion or they have orders in pipeline. So this is very important. We are seeing this, then we will see the corporate profits will also to return. And also we want to highlight number five is about housing. Last Friday, our whole team was in Shenzhen. We are doing our macro due diligence trip. At this trip, we are checking about the housing. Then when we're talking with the property agents, we are seeing there are around 5 times of the people who are visiting to viewing the apartments, and also 5 times in terms of purchasing due to their rigid demand. So this, we are seeing some kind of, revitalization in terms of the housing market. The last one, as just now William has been mentioning, is about the equity markets. So not many people really noticed. In February, the CSI 300 has been up over 9.4%, but S&P is only up 5.2%. So China has changed its chairman for the CSRC, and also China State, team has been really injecting money into the stock market at more than 460 billion in RMB into the system. But we think this trend will continue only if the corporates, starts to have orders, they have business confidence, then, they have profits, they have returns, then the markets can be sustainable. Thank you.
Right. Thanks, Mo. I really like that tidbit where you say there's a lot more viewing of properties in Shenzhen. I think after the Hong Kong budget, there was also news that residential properties in Hong Kong are starting to sell in hours. So I think it's linked to the next question, which we have. Do you think Hong Kong's golden age as an international financial center is over? I think Stephen Roach was on Bloomberg TV saying that effectively Hong Kong has changed. It's lost its age, where it was previously viewed as very embracing free markets and strong institutions. So I think there are probably a lot of question marks over Hong Kong right now. So I think you viewers will be interested to hear a view on this question.
Yes, this is also like why we have been issued a paper, is Hong Kong's game over? Actually, what we really want to is address Stephen Roach's arguments. We don't think Hong Kong is over. As I just now have briefly, mentioned, in terms of rule of law, Hong Kong has been ranking much higher than many countries, even like the US. So this is something, nothing has been changed, no matter what has happened in the past 5 years. And also, Hong Kong, in terms of the China's ODI, Hong Kong receives over 60%, and China continues to do the rediversification. Because of US-China tensions, Hong Kong is the biggest beneficiary. So this is why we are seeing Hong Kong's money inflow actually has been very strong. And also China wants to build RMB center. Then Hong Kong is the best place for RMB to be internationalized. And also you see China now has been a lot of collaborations with Middle East, and Hong Kong is also the best place to do so. In terms of the asset management, private private wealth management, I have to say, among all the categories, only one, actually among all this, Hong Kong all rank above all other places. So this is why we see, money now is coming back. So in terms of even U.S.-China, tensions, then in terms of rediversification, because Hong Kong's, special location within the Greater Bay Area, China, whenever they want to do the rediversification, Hong Kong is a very good place for electronics, export before. And going forward, we think when China has been stepping up in all of this, Hong Kong will be a very good gateway for China to export all those very high-end manufacturing products or ultra high-end manufacturing products through Hong Kong to all other places around the world, maybe only except the US. So this is why we see, for Hong Kong in terms of engaging the talents, Hong Kong has been having a another reverse trend. Many of the talents come to Hong Kong, especially for the young people. So this is something we want to see, to revive, the international financial center, to be the golden age. Certainly it takes time because Hong Kong still faces the financial challenges, but we think it's not something, too far away for us to see. Thank you.
Yes, thanks, Mo. I agree with you. Hong Kong has always been very internationally oriented. I'd like to take a break. My next question is directed towards Han Ting. So other than growth policies, what are some key household support policies in the latest Singapore budget? I guess given the amount of goodies that has come through, some people could be asking, is this an election budget? So what are your thoughts around it?
Yeah, I actually think the budget has been quite comprehensive. Not really sure whether it's an election budget per se, but certainly a forward Singapore budget. So just now I mentioned quite a lot on the business initiatives that's being put out in the budget, but there's also quite a bit of policies that's being done on the household and social side. So I think in the near term, there has been tops up to the assurance package. So Singaporeans would, for example, have more CDC vouchers in June this year and also January next year. And as well, on top of that, Singaporeans will also receive a personal income tax rebate. So that's more on the near-term challenges, how to tackle some of the near-term issues with regards to cost of living. But there are also longer-term policies. So, for example, in terms of the aging population, we see that the government has committed in around 3.5 billion in the Aging Well program, which is essentially to build out some of these infrastructure and community areas for the aging population to age well, in the sense that you continue to be healthy and active and be productive. Also, another thing, I think it's in terms of retirement adequacy. In last year's National Day rally, we heard of the Majula package. So, in this budget, the government has committed 7.5 billion in funding this Majula package, which should enhance, the retirement adequacy of a lot of Singaporeans.
Right, so these are very progressive initiatives by the government. I think we have time for just one more question. So why is the US economy not in recession, as most commentators predicted in 2022 to 2023? How would you assess US recession risk in 2024? What are the implications for China? So that's a big question, lots of things to unpack. I think the first observation is that historically, when the Fed was tightening policy rates in the past, for instance, in the 05-07 period, as well as from in the late 90s, that has typically preceded a slowdown, a recession in the US. It even initiated a financial crisis back in 2008. So clearly, this tightening cycle is a bit of an outlier in terms of what the outcome has been for the US economy. We have seen some signs of activity slowing down, but no signs of a recession. So have recession risk completely disappeared, or is still a risk for investors to watch? I think probably there are two reasons why the economy is more resilient now compared to where it was in the previous tightening cycle. The first reason is that we have pandemic-era stimulus that really provided households with very high savings, and we're seeing a drawdown of that savings powering growth, right? So stimulus from that perspective have been very important in supporting growth. It's not completely dissipated. Consumer and household balance sheets are still relatively strong as of this point in the cycle. The second point to make is really about financial risk being much better controlled in this period as well. So in the past, there were, I think, a lot of too much leverage in the financial sector in the US that created, I think, a series of banking failures that precipitated the global financial crisis. But this time around, despite what has happened in the pandemic, banks are in a stronger position with high capital buffers. Lending was not too out of hand. Debt levels have been a bit higher compared to where they were 10 years ago. But by and large, we have not seen a massive increase in corporate failures, in corporate defaults. We still expect some rise in US defaults, partly because it takes time for high interest rate to filter down to interest expense. But by and large, we don't see a very significant financial crisis kind of scenario where that could lead to a kind of a recessionary scenario. We are more likely to see a slowdown in activity, and there are some signs the job market is already starting to cool in the latest non-farm payrolls data. So by and large, we see a more benign soft landing scenario, but at the same time, aware that we could be wrong. Risks continue to exist in selected pockets of the economy, particularly in the US commercial real estate segment, and those segments we are watching closely. So with that, we will tie up our Macro Insights live stream for this month. Thank you for viewing and your questions, and we look forward to hosting the next live stream with you guys next month. Thank you.